Hey everyone, let's jump right into this explainer tailored specifically for all you CMA students out there. We're tackling a massive topic today, the hard and fast rules of audit working papers and evidence. Whether this is your first pass through the material or you're doing that final frantic polish before exam day, we're going to break down these complex standards into clear, highly visual concepts that will actually stick in your brain.
Here's our quick roadmap for today. We've got types of working papers, ownership and file custody, what is audit evidence, and finally, the need for evidence. Let's get to it.
Starting off with Section 1, Types of Working Papers.
Okay, so when you're conducting recurring audits year after year, your documentation absolutely has to be organized logically. The biggest thing to grasp here is the hard contrast between the two main types of files. Your permanent audit file, that's your ongoing knowledge base. It holds information of continuing importance. On the flip side, the current audit file is, well, exactly what it sounds like. It contains information relating exclusively to the audit of one single specific period.
This setup right here brilliantly illustrates the exact contents of both files side by side. And listen, this is a classic area where exam questions love to try and trick you. Examiners will mix and match these lists in multiple choice questions all day long. So getting a really clear visual map of this table in your head is going to be a real game changer for you.
What's really interesting to notice here is how every single item in the permanent file, things like the Memorandum of Association or historical ratios, maintains its relevance year over year. Think about it. A company's legal structure or their core accounting policies, they don't just change every 12 months. When an auditor sits down to evaluate an entity, they need this foundational context, right? They need that historical baseline of internal controls and past audit observations to truly understand the business's ongoing risk profile. You basically build this file once, and then you just tweak it as major structural shifts happen.
Conversely, looking at the current file, these items are strictly tied to the single period you're auditing right now. Notice how everything here essentially has an expiration date on its immediate relevance. The correspondence for this year's appointment, the analysis of this year's specific transactions, your audit program, and the conclusions you've reached for this specific year. Once the audit report is signed off, these documents are locked into the current audit file for historical record, and next year, you start a brand new one.
Moving right along to Section 2, Ownership and File Custody.
So, once you've done all the work and compiled these files, who actually owns them? For your exam, you absolutely must remember the Chantry Martin & Co. case. This landmark case firmly established that audit working papers are the property of the auditor. Management can't just barge in and demand you hand over all your working papers. You can choose to provide portions or extracts, but that is strictly at your own discretion. But remember, with ownership comes immense responsibility. You have to keep them in safe custody and keep them strictly confidential.
And that brings us to a magic number, a number you literally have to memorize for your exams: 7.
According to the Institute of Chartered Accountants of India, through SQC1, you must retain these files in safe and confidential custody for a period of 7 years. If you don't, well, you'll be held guilty of professional misconduct. Imagine a regulatory body requires a look at an audit you performed 5 years ago. You have to be able to produce that documentation. If you can't, the professional consequences are severe. No exceptions.
All right, so we've got the files secured for 7 years, but that raises a really important question. What actually goes into them to prove our case? We know how the files are categorized, we know we own them, but what's the actual substance of the information inside?
Which brings us directly to Section 3. What is audit evidence?
Look, an audit isn't just taking management's word for it, right? You are rigorously evaluating their assertions. Standard SA 500 defines audit evidence perfectly. It's simply the information used by the auditor in arriving at the conclusions on which your final opinion is based. This includes both the underlying accounting records and substantive information from other sources. Think external bank confirmations or physical inventory inspections. It's the cumulative substantive proof that gives you the confidence to stand up and say, yes, these financial statements present a true and fair view.
Finally, Section 4, the need for evidence.
Why do we need this evidence to be rock solid? Well, this sequence lays out exactly why objective examination is so critical. If you form an opinion based on just a casual, subjective glance at the records, you're leaving the door wide open for material misstatements or even massive frauds to go completely undetected. And when that inevitably comes to light, you won't have the evidence to defend yourself, and you'll be found guilty of professional negligence. It's really that simple. To obtain reasonable assurance and reduce audit risk to an acceptably low level, Standard SA 200 requires a really careful balance of two things: sufficiency, which means the quantity of your evidence, and appropriateness, which means the quality. You need both to survive in this profession. Having a massive pile of completely irrelevant evidence, not helpful, so quantity alone fails. But having one incredibly reliable document might not be enough to prove an entire year's worth of complex transactions, so quality alone can fail too. You have to continuously exercise your professional judgment to ensure you have enough of the right kind of evidence to confidently sign off.
I'm going to leave you with this thought to ponder as you master these standards for your CMA exam. If a casual evaluation leaves a massive fraud undetected, will your lack of sufficient and appropriate evidence lead to a charge of professional negligence? Absolutely. Remember, your permanent and current files aren't just tedious paperwork, they are your professional shield. They're packed with sufficient and appropriate evidence that you own and that you must protect for 7 years. Master these core concepts.
Think of today's explainer as a financial detective's ultimate blueprint. We're going to decode one of the most absolutely crucial areas of your syllabus: audit evidence and the auditor's judgment. Because, as an auditor, you aren't just glancing at numbers. You're piecing together a massive puzzle to verify that a company's financial statements are actually true and fair. It takes a really sharp, skeptical mind to know exactly what clues to look for. So grab a coffee, get ready to take some mental notes, and let's break this whole thing down.
Okay, let's dive right into this. This is the core question of literally any financial detective's investigation. How much evidence is actually enough? When can you close the file and say, yep, I'm reasonably assured these financials are accurate? Or alternatively, whoa, wait a minute, something isn't right here. Obviously, you can't examine every single transaction in a giant corporation, so knowing when to stop looking and actually feeling confident in that decision relies entirely on the auditor's professional judgment.
Here's our visual syllabus for today. We're going to systematically unpack 4 key areas. First, we'll look at the auditor's judgment. Second, the types of audit evidence. Third, we'll cover relevance and reliability. And finally, number 4, the actual methods to obtain evidence.
All right, let's kick things off with Section 1, the auditor's judgment. Before we look at what actually influences that judgment, we really need to define 2 major interrelated concepts straight out of SA 500. Those are sufficiency and appropriateness. Sufficiency refers purely to the quantum, the sheer quantity of the audit evidence you've obtained. Basically, do you have enough of it? Appropriateness, on the other hand, relates entirely to the quality of that evidence, specifically its relevance and its reliability. Is it the right kind of evidence? Now, listen closely, because confusing the quantity of sufficiency with the quality of appropriateness is a super frequent exam trap for CMA students. Don't fall for it.
Now, what's really interesting about this slide is the specific clues that guide a financial detective's judgment. When deciding what is sufficient and appropriate, your judgment is influenced by a few entity-focused factors. First up is the nature of the specific item being audited. Second, and this is a big one, is the adequacy of the company's internal controls. Think about it. If their internal check system is weak, you're going to need a whole lot more evidence, right? You also have to consider the nature and size of the business they carry on, any weird situations that might exert an unusual influence on management, and just the overall financial position of the entity itself.
But, the entity itself isn't the whole story. The auditor's judgment is also massively shaped by the audit process. You have to look at the materiality of the item, like how big of an impact would a mistake here actually have. Then tap into the experience gained during previous audits. Were there issues with this client last year? You'll also look at the results of your current auditing procedures, especially if you've already stumbled onto red flags like fraud or error. And finally, your judgment is guided by the type of information that's actually available to you, along with the trends indicated by your accounting ratios and analysis.
Moving right along to Section 2, types of audit evidence. Where do these clues actually come from?
Depending on the source, audit evidence generally falls into one of 2 buckets. First, we have internal evidences. These are collected from right inside the organization. We're talking about documents generated by the company's own staff, like sales invoices, counterfoils of cash memos, goods received notes, or credit and debit notes. On the flip side, external evidences are collected from outside sources. These are things like market quotations, or those all-important written confirmations coming directly from third-party debtors and creditors. You've got to contrast these in your mind because they are absolute must-know exam definitions.
And that brings us to Section 3, relevance and reliability.
So the crucial point here is understanding exactly what relevance means under SA 500. Relevance deals directly with the logical connection with the purpose of your audit procedure. And because of that, it's deeply affected by the direction of your testing. For example, if your goal is to prove a company actually owns an asset, looking at a routine maintenance record isn't really logically connected to ownership, is it? You'd need to look at the actual title deed. That's relevance.
Okay, if you're taking notes, star this slide, presenting these generalizations as absolute cheat codes for your exam. SA 500 gives us these golden rules for assessing reliability. First up, source. External evidence, like a bank confirmation, is generally far more reliable than internal evidence. Second, controls. Internal evidence is only considered highly reliable when the related internal control system is actually satisfactory. If controls are weak, the evidence is weak. Third, format. Evidence in the form of written documents is usually way more reliable than just oral representations. And finally, the collector. Evidence obtained directly by you, the auditor, is always more reliable than evidence handed over by the entity.
Now for our final section, number 4, methods to obtain evidence. Let's look at the actual toolkit. An auditor obtains evidence to perform their compliance and substantive procedures by using one or combination of these 5 key methods. We have inspection, observation, inquiry and confirmation, computation, and analytical review. Let's briefly break down exactly how each one operates out in the field.
Let's move to and see how this builds. Method 1 is inspection. This consists of physically examining records, documents, or even tangible assets. Remember, though, the reliability of inspecting those records depends heavily on their nature, source, and how effective the internal controls over their processing are. Method 2 is observation. This isn't about static documents. It's about dynamic action. Observation consists of literally witnessing a process or procedure being performed by others, like watching the client's warehouse staff do a physical inventory count.
Next up in the toolkit, we have inquiry and confirmation. These two operate beautifully together. Inquiry consists of seeking appropriate information from a knowledgeable person, either inside or outside the entity. Basically, you're asking the probing questions. Then, confirmation is the crucial second step. It consists of the actual response to that inquiry, which you use to specifically corroborate information contained in the accounting records. You ask the question, and then you get the confirmation to lock down the facts.
To round out the toolkit, we contrast mathematical precision with big-picture trend spotting. Computation simply consists of checking the arithmetical accuracy of source documents and accounting records, or just performing independent calculations. You're checking the math. Analytical review, on the other hand, is much broader. It consists of studying significant ratios and trends and actively investigating unusual fluctuations in items. If a specific expense jumps 300% in 1 month, analytical review is the tool that flags it and tells you to go investigate.
And this brilliantly illustrates the whole point. This quote summarizes exactly what SA 500 demands of you. The auditor should evaluate whether he has obtained sufficient appropriate audit evidence so that reasonable conclusions can be drawn therefrom. Everything we've just discussed, from assessing entity risks to actively inspecting documents and analyzing trends, serves that one singular goal. You need enough of the right evidence to make a reasonable conclusion.
I want to leave you with a final thought to really test your professional skepticism. If a massive material misstatement is cleverly hidden by management within their own internal documents, did the auditor exercise enough professional judgment to go seek reliable external proof, or did they just accept the internal paperwork at face value? That is the true test of an auditor. It's exactly the kind of critical thinking that's going to help you completely ace your CMA exams.
Today, we're going to build a mental mind map to help you absolutely master how auditors obtain evidence under SA 315 and SA 330. We're going to break down the dense language of the standards into clear, testable concepts. Let's get to it.
Here's our roadmap for breaking down the audit evidence hierarchy. We'll start with obtaining audit evidence, move into risk assessment procedures, then further audit procedures. After that, we'll look at testing controls via compliance procedures, testing numbers via substantive procedures, and finally, an exam strategy recap.
Let's kick things off with Section 1, Obtaining Audit Evidence, and the core objective behind SA 315 and SA 330. So the whole point here is that an auditor's final opinion absolutely has to be based on reasonable conclusions drawn directly from the evidence. You can't just guess, and you definitely can't assume. The standards explicitly state that to draw these reasonable conclusions, you obtain evidence by performing two distinct things: risk assessment procedures and further audit procedures. Keep this two-part structure in mind because it forms the trunk of the tree we're about to climb.
Moving into Section 2, Risk Assessment Procedures. Think of this as Phase 1, essentially casing the joint.
Now, the chronological sequence here is super important for your exam. You absolutely must assess the risk first before you can determine what further procedures to perform. I mean, you wouldn't send a tactical team into a building without knowing the floor plan and where the threats are, right? In auditing, risk assessment tells you exactly where the high-risk areas are so you can target your further procedures efficiently.
What are we actually doing during risk assessment? Well, we're trying to find where material misstatements, whether they're from fraud or just a simple error, might be hiding. You do this by getting a really deep understanding of the entity, its environment, and its internal controls. And you're specifically assessing risks at two levels: the broad financial statement level and the specific assertion level. Now, assertions are basically just management's representations, what they are explicitly or even implicitly claiming in those financial statements. Once we know the risks, we hit Section 3, Further Audit Procedures, which acts as our two-pronged attack. Prong A of that attack is Section 4, Testing Controls, also known as Compliance Procedures. This is where we test the company's internal security system.
Diving into this first prong, we aren't actually looking at the final numbers yet. We're testing the controls. But before an auditor can test anything, we have to ask, what is management actually asserting about their own internal controls when they hand over the books?
Basically, management is making an implied promise. They're telling the auditor, hey, our controls are effectively designed and they're operating effectively. It's the difference between having a fancy alarm system sitting in a box versus having it installed, turned on, and actively monitored. In the initial audit planning stage, the auditor checks the design. But in the control testing stage, using these compliance procedures, the auditor gathers evidence on the actual operational effectiveness of those controls.
And here is why this is a massive deal for an auditor. The primary objective of an audit is to gather evidence that account balances are complete, valid, and accurate. Well, guess what? That is the exact same objective as a company's internal control system. So, if those controls are actually effective, the auditor can plan to rely on them. Relying on their system to catch the errors drastically reduces the amount of substantive evidence you manually have to gather later. It's a huge time saver. So how exactly do we test these controls? The actual detective work involves a few key activities. You might observe an internal control procedure happening in real time. You might inspect physical evidence, like making sure a control was performed at the right time with the right signatures. You'll make inquiries, literally asking the staff how and when they do things. And in computerized systems, you'll gather evidence using CATs, computer-assisted audit techniques like generalized audit software or embedded modules.
That brings us to Section 5, Testing Numbers, or Substantive Procedures. Let's call this Prong B, Counting the Vault.
Okay, I really want you to cement this side-by-side comparison in your mind for Test A. On the left, compliance procedures test the operational effectiveness of the controls to hopefully reduce our workload. On the right, substantive procedures test the hard numbers through tests of details and analytical procedures. This is where we are hunting for evidence regarding three specific management assertions about their balances and transactions, that they are complete, valid, and accurate.
Let's put some concrete examples to these concepts. To prove validity, that an asset actually exists, an auditor might physically examine inventory right on the balance date. To prove completeness, that no liabilities are missing, they might arrange for suppliers to confirm in writing exactly what the company owes them. And to prove accuracy, specifically regarding valuation, they might inquire with management about whether customers can actually pay their outstanding debts.
Now, within these substantive procedures, you've got two categories: analytical procedures and tests of detail. Look at how they compare. Tests of detail give you far more reliable evidence than analytical procedures. Also, while analytical procedures can be applied across several different stages of the audit, tests of detail are strictly applied during this specific substantive testing stage.
All right, let's bring it all home with Section 6, Exam Strategy Recap. Time to lock in this mind map.
We've covered a ton of essential ground today. If you only remember one phrase from this entire explainer, make it this: completeness, validity, and accuracy. If you find evidence that an account balance or a class of transaction fails any of those three tests, if it's not complete, not valid, or not accurate, you are officially looking at a substantive misstatement.
Let me leave you with a quick question to test your instincts. Does a flawless control design matter if the day-to-day operation is a total mess?
The answer, of course, is no. As we saw, controls must be effective in both design and operation for an auditor to rely on them and reduce their substantive testing. Keep that logical flow in mind, and you are going to absolutely crush these concepts on your exam. Thanks for joining me on this explainer.